Saul Kavonic is head of energy research at MST Marquee. He joins us live now for more insights on this OPEC decision and what's next for oil. Saul, we have to begin just by putting it out there pretty bluntly. If you're a shale CEO this morning, are you laughing or are you panicking at what's just unfolded? Good morning.
Good morning. Well, the US shale patch, which have been very big supporters and have a close relationship with Trump, are not going to be happy with this, because ultimately this is an example of OPEC increasing their market share, which ultimately does come at the expense of the United States patch. And in particular, it's about pricing, where, what used to be a floor 5 years ago, the cost structure has increased. We probably do need to see WTI not fall too far below 60 in order for the US to maintain the level of supply growth that it's seen. If you start to see further downward pressure here, driven by both the macro weakening of demand in the face of these tariff wars and now OPEC accelerating its cut unwinds, that's going to put pressure on the folks down in Texas and Louisiana and elsewhere to pull off the rigs and not drill as much. And that's not going to make them very happy. But if we keep going down that path, you will have to see that supply response to balance the market. But just to be clear, we're not there yet. There's quite a few other considerations at play here before we start to see oil prices collapse much further.
Okay, so walk me through this and take me inside the OPEC mindset here. What are they seeing and what justifies this accelerated output increase?
Well, as a starting point, the reason the market's so shocked here is in face of the tariffs announced yesterday, which is going to materially weaken the demand outlook for oil. Just as a rough proxy, 0.6% of GDP is about 1% of oil demand. And so the market, if anything, was expecting OPEC to withhold supply and slow the rate of its planned cuts, but instead they've done the exact opposite and they've accelerated the cut unwind that they're planning. But OPEC is a very sophisticated and seasoned organization, right? They're doing this with three key considerations in mind. First of all, this is partly about appeasing Trump, because Trump will be putting pressure on OPEC to reduce oil prices, which reduces global energy prices, to help offset the inflationary impact of his tariffs. But the second thing that OPEC is going to be looking at here is about compliance within the group. So they agreed last month to make some compensation cuts because there's some laggard nations in there which haven't been cutting as they should have. If those cuts are made, this accelerated unwind is actually going to be completely offset, and OPEC will just be on track with its more regular cut increase on a net basis from May through to August. And finally, keep in mind that seasonally, crude demand runs are actually going to pick up over the next few months, particularly from about May through to August. And so actually, the threat of oversupply is not really in the near term. It's only what happens in the second half of the year. So OPEC are using this seasonal uptick in demand in order to experiment with the unwind of the cuts to appease Trump, to create some more room, for example, for Trump to impose sanctions on Iran, and to create compliance and unity within OPEC Plus itself, without actually causing the market to go into surplus in the physical sense. And so those are the considerations which I think are factoring into OPEC's thinking here, and why it's premature for the market to actually be panicking that we're going to see oil drop below $60 or $50 like we saw in 2020. We are nowhere near those level of concern yet.
I'm also firmly of the view, and I believe we share this view, but I'm firmly of the view that nobody has a better read on these markets than these OPEC ministers. And one thing we consistently hear from this group is that they have the production flexibility to either increase or decrease as necessary to cater to the needs and the demands of the market and the investment outlook. And I think that's also what we're seeing play out here. But do you think this also represents somewhat of a shift in strategy here, perhaps? You outlined some of the factors. Yes, I would agree with most of what you said. But is this the end of OPEC's voluntary cut era or just a short-term flex?
Well, let's be clear. I think OPEC is still holding a lot of the cards here and in a lot of control. And you can see it from the message from OPEC that this is still part of their overall plan and strategy, and that they're not deviating from it. I think the only factor at play here which could suggest that this is fundamentally different is not about the demand outlook, because OPEC can manage that. It's about the geopolitical pressure that Trump might be brought to bear on OPEC. Keeping in mind the uncertainties that are going on regarding the Middle East, particularly with Iran, the move of US defense posture back into the Middle East region, and Trump's domestic priorities in alleviating inflation, albeit he's causing inflation, but he's looking to energy to help mitigate that. And so could we see overbearing pressure being brought from the US administration on the likes of the Saudis and UAE to accelerate this and put downward pressure on oil? That's what could get, that could signal a departure. But fundamentally, OPEC's position here, its management of the market, its ability to do so, and the lack of any other country in the world to do so still leaves the cards in OPEC's hands. And I don't think this, what we've seen overnight, is a signal of a big departure from the strategy that's worked so successfully for them since the middle of 2020.